Well, hello folks, LA here, US weekly review. It's August 21st, or at least that's of the date that we're reviewing on. Today's 23rd is Sunday. Let's look at what's happening in these markets. If we look at the numbers here, what we see is what we have seen, and that is that we've got a market that just continues to want to drive to the top side, right? We've got S&P up 0.72, hitting all-time highs. So closes at all-time highs, hits all-time highs, and what was driving it? NASDAQ NDX, right? Especially big cap tech stocks. Same sort of thing we've seen for a long time. It keeps coming back. We saw small caps actually fall. Gold was about flat. Bonds had a big down week the week before. They bounced back pretty good. Of course, you know you've got the Fed in these markets buying these bonds, creating artificial demand. And the dollar actually finished flat. Now, the dollar, if you remember, the dollar did an ABCD down, tried to push lower this week, and actually came back and finished flat. So I think the dollar, as I said last week, is probably finding a bottom here, down 3% on the year, and the dollar down 4% on the junk bonds, down 7% on the Russell. Everything else up big on the NASDAQ, NDX, gold, and bonds, treasuries that is. S&P in the middle. Why is this market moving higher? You know, sometimes you can look at something and it can look to you as if everything's fine. You know, on the surface, so to speak. A lot of times I speak about, you know, what does it look like under the covers? If you look under the covers, other than builders last week, everything was down except, well, I shouldn't say that. We actually had durables slightly up, and same with healthcare. But essentially, you had everything down except the two big drivers. And what were they? Technology and discretionary, which is essentially Amazon. Those were the big drivers. This was what was taking the market up last week. Look at the gains, the losses, energy sector. Look at the financials. Financials are just being dragged, through the mud right now. Industrials started to lose, basic materials. This is where rotation was going to. All that just disappeared. Even communications got hit. Technology, big cap technology, the six big stocks, they're driving this market, have been driving this market. And if you look at the weighting over here, these two, and this is about 25% now, I haven't updated this in a while, but the bigger it grows, the larger percentage it gets. We're talking 35% of the market in these two sectors, right? And these two sectors are what's driving it. That's what's pushing this market. That's what's keeping it going up. And what's happening is the participation is getting more and more narrow. You can see that in various ways. For example, if we look at the weighted and the non-weighted, right? Here's the weighted all-time highs. That's the S&P itself. Go to the RSP, right, which is an equal weight of the S&P. Hasn't even hit the prior high that was set about halfway up on this move. Certainly hasn't even gotten over the breakdown bar, right? It's still trying to get back up there. Big difference. Look at the, in terms of timing now, look at what's happening with the trends. You know, we got bearish trends, we got bullish trends, we got sideways trends. This is looking at bullish and bearish, red being bearish, green being bullish. And then it's plotting the S&P 500 over the top of it in this dashed line. If you look back, most of the cases where you have divergence, in other words, you start to go down on the bullish trends. In other words, there's fewer and fewer stocks in bullish mode. In other words, they have transitioned to sideways or to bearish. And the market continues higher. What do you get? You get a market sell-off that follows. Here's another case, right? Sell-off that follows. This was the big case, right? Market tries to go up. Matter of fact, all the way up here as it pushed and pushed and pushed. Eventually, that turned and we got a huge sell-off. That was the February crash. Here's another case where we are now, right? Where the market continues up and we're doing the same thing. Right? This usually leads to some sort of a retrace. Now there are cases where it can continue for a while, and that, like this case, right? Market going up, this starts down, and yet the market didn't pull back. Now, are we in one of those cases where this is just going to continue up like this did back here? It's possible, and the way you do that is either those stocks that are carrying you just continue to carry you, or you get rotation back in. And in this case, it was a narrow group that was carrying us mostly, and they continued to carry us for quite a while. That's where we're at. This is again telling us internals, they're diverging, which usually precedes a retrace. It's something to be aware of. We're starting to see the bearish trends pick up, bullish trends kick down. Dollar. This is where I was talking about the dollar. Done an ABCD down, finished, gets under it, does a hammer, closes back. A little bit more volume than I'd like, but this is on an ETF, right? We're looking at the UUP, and it's on a weekly time frame. This should bounce back up into here. And if that does, that's going to be negative for equities, negative for precious metals. It's also the case that when we break out, and this is on the S&P weekly, when we break out, typically what happens is you get a retrace and a retest regen within 6 bars. And so usually you're going to see this thing pull back in, retest, and try to regenerate higher. Now if it does it, and it does it immediately, because this is such a small swing point high in terms of the width, top to bottom, the odds are heavier that this will fail and it will actually get under it, and that will say you got an intermediate term top. Now if it does retrace and regenerates and kicks back up, it's a different story. So really the next 1 to 3 weeks are kind of critical. If you see this continue up, right, the next 3 weeks, well then this thing's going to have a much better chance of holding on the retrace. If it comes back immediately, maybe this week, maybe towards the end of this coming week, or the first of next week, and you don't get much of an extension to the top side, then you have a much better chance, right, of this thing actually failing. Now on the flip side, I've pulled down to the daily now on the S&P. On the flip side, if it pulls back and does that test, this 33.26 correlates with that 33.28 area on the weekly chart that we were just looking at, which is the bottom of the swing point high. And so that area looks like a pretty good area to get some buyers. If it fails there, it's going to come back into the swing point high, and it will be the first test after more than 6 bars. And so it's going to have a very good chance of getting bought down here. The difference being you're going from 3,400 down to about 32.65 or so, or actually it's a little higher, about 32.80. So you drop off 120 points on 3,400, 3% is not that much. But that's the case, right? So when we say the market should pull back, it looks like it's going to be a short pullback, and then we're going to try and bounce it again. Now, when we get there, assuming it breaks down to here, for example, you're going to have this swing point low as a retest regen to the downside. And so you're going to be caught between these two, and you're going to have something to measure it against. Now, if it just gets to the swing point low, doesn't break, and starts to bounce, well, you just have to assume continuation. Note that even before all this happens, we still could just keep climbing, right? 34.65 is the next target. It's not that far up. The higher one's 37.30 above in terms of these ABCD structures. So another, 2%, you can hit the next structure, and that's possible. I mean, we definitely you could hit it this week pretty easy. Just as an aside, it's this was a chart that you should look at and recognize that something's going on in the inflation side of the equation. Usually what you would see is bonds selling off with this happening, but they're not, because you got the Fed intervening in these bond markets. It's intervening in the corporate bonds. It's intervening in the treasuries. It's intervening in a number of these markets, debt markets. And typically you would see they sell off. They're not, but you would also see precious metals continue to get bids. And I suspect, once this pulls back and recharges and goes back higher, these precious metals, and that's probably going to be at the same time that you see the dollar do it. You're going to see the precious metals come storming back. But they're probably in an intermediate term top, which I pointed out last week. The reason I say this shouldn't have done this and inflation looks real is because this was the break, right? This arrow here is a confirmed break. Got a huge steep drop, right? And then this thing's climbed all the way back up, and the retest regen, it just blew right through it. And so we should see, and this is the continuous commodity ETF, we should see commodities continue to get bid, of which precious metals is part of it, but other things like the basic materials, all of the non-metallic commodities as well as metals should continue to see bids, and that suggests inflation. What's the bottom line? We don't have any hard evidence yet, right? Still don't. Now, what I have seen is two things I've seen recently is on the 30-minute chart, I've seen ABCD, bullish ABCD structures fell, right? Not get up to those targets. And so they get up here somewhere and then fell, and they take out their C points. That suggests a slowing of momentum, right? And that's more of a sideways thing. And so this has started to happen. The next thing, if you want to be bearish or you're looking for clues as to the turn, is you want to see bearish ABCD structures form and fire, right? And then fulfill. Don't have this yet. This hasn't happened yet. And that's on the smallest time frame, which is the 30-minute time frame, right? And so we're looking, or I'm always looking at that. I do those numbers each day on the S&P in terms of ranges. That's what I'm looking for as the first evidence. And right now we don't have it. We're starting to see the first, but we haven't seen the next one. The other thing we're starting to see is usually the VIX travels at a different direction, or in a different direction than the S&P. The S&P was up on Friday. The VIX was up as well, would not come down. That's also usually an indication of the market getting ready to do some sort of a retrace. That's the increasing evidence, along with the other things that I've shown you earlier, suggesting that we're nearing this retrace point. We may hit the weekly targets. They're only 2% higher, which I'd already mentioned. But if we get that immediate retrace, it's more problematic. I think it's going to probably fail, which would say that you have an intermediate term top. And it would be interesting because on the S&P, that intermediate term top is going to end up where a double top would occur. And a lot of people are going to start talking about that. Despite all of that, even if all these things happen, despite that, first push down on the daily chart is most likely going to get bought on that bullish retest regen. If we move to prognostications last week, better than expected one more time. And if I look at this coming week, I'm still in this retrace. I'm still thinking retrace. I'm thinking the bottom of that swing point low is what you could expect this week. Whether we get a little bump up and then a move down, however it comes out, I would expect some sort of an attempt to test that. On the worst case scenario, I think you go back and do a retest regen on that swing point high on the daily. Best case is move on up to an ABCD target on the weekly. That would be the best case expectations. That's it for this week. Have yourself a great one. Stay safe. I'll see you next time.